All right, let's dive into Dynex Capital's latest earnings call. Now, on the surface, this quarter looks like a bit of a miss, but trust me, if you dig just a little deeper, there's a really interesting story unfolding here. It's one the market might be completely sleeping on. So, let's break it down.
So this is the number management is absolutely screaming about, 10.3%. That's their total economic return for the quarter. I mean, that's a home run, right? But here's the weird part. The stock barely moved. So what's the deal? Well, it seems Wall Street had its eyes glued to a completely different metric.
Okay, here's how we're going to tackle this. First, we'll hit the Q3 scorecard. Then we'll unpack management's playbook. After that, we'll dig into the analyst Q&A for some hidden gems. And to wrap it all up, we'll give you our take on what's next for the stock.
All right, first up, the scorecard. And man, this is really a tale of two metrics.
Okay, check this out. The big headline number, adjusted EPS, yeah, that was a miss. But look at everything else. Net interest income actually beat expectations. And here's the really important one for a company like Dynex. Book value per share. It absolutely shot up. Now, if you're not familiar, just think of book value as the real underlying value of all their stuff. And it grew a lot.
So this is the classic conflict you see on Wall Street all the time, right? The flashy headline number, the earnings, looked weak. But the substance of the business, its actual book value, is getting stronger. And that's exactly how they got to that incredible 10.3% economic return. It's all about the book value growth. So you're probably wondering, how on earth did they do that? Well, that brings us to their playbook.
You heard it straight from the co-CEO, Smiri Papino. He's calling this a generational opportunity. And what he's talking about are these agency mortgage-backed securities, which, are basically just big bundles of home loans that have a government guarantee. This has been their story for a while. But this quarter, they're basically saying, see, we told you so. The bet is working.
And listen, to really get what they're doing, you have to understand this one term, total economic return. It's not about the earnings you see every quarter. No, for a company like this, it's all about how much their book value grew, plus the dividends they paid you. It's the true measure of value they created, and believe me, it's the only number they want you to be looking at.
So, what was the actual play? It was pretty straightforward, really. Step 1, raise money. They pulled in about $250 million. Step 2, go shopping. And boy did they deployed over $2.8 billion into those mortgage securities. And step 3, the most important part, they managed their risk. They kept over $1 billion in cash ready to go and didn't go crazy with debt. That's not just a plan, that's confident execution.
Now, to be fair, they didn't do this in a vacuum. The market gave them a nice tailwind. You had 10-year Treasury rates dropping, which is great for the value of their assets. You had mortgage spreads tightening, another plus. And then, the cherry on top, the Fed cut rates in September. For a company like Dynex, that's basically a guaranteed reduction in their financing costs coming up. A pretty nice setup, you have to admit.
Okay, now for my favorite part of any earnings call, the analyst Q&A. This is where you get to peek behind the curtain and hear what the smart money is really focused on.
So what was on their minds? Were they all bent out of shape about that earnings miss? Nope, not even a little. They were looking ahead.
Here's the rundown of what they were grilling management on. First, returns. They asked, hey, the stuff you're buying now, what kind of returns are you getting? The answer? Mid to high teens. Very strong. Then, book value. Management confirmed it's actually grown even more since the quarter ended. They also talked a lot about hedging. With markets so quiet, management is buying up what's essentially cheap insurance, options to protect them if things go haywire. And finally, a bit of a technical one. They dug into spreads, confirming the real opportunity isn't just versus treasuries, but against more complex things like interest rate swaps. This tells you the pros are looking at the sophisticated stuff.
So let's put it all together. We have the numbers, we have the strategy, we've heard what the analysts are thinking. So what's the verdict? What happens next? Here's our take. So, why the flat stock reaction? Here's our thesis. The market gets it. They see the book value growth. That story is now priced in. The narrative is shifting. It's no longer about preserving value, it's about proving you can generate consistent, durable earnings from that value. It's officially a show-me story now. And let's be real clear about something. It's not like the stock has been a dog. Just look at the one-month performance leading up to this earnings call. Dynex was up almost 9%. Meanwhile, the whole sector, the MREIT ETF, was down nearly 2%. So a lot of that good news about book value was probably already baked into the price before the announcement even happened. That context is crucial. All right, so time for our official call. Here's our prediction. For next quarter's results, we do expect core earnings to tick up. Those lower funding costs from the Fed rate cut should start flowing through. But what about the stock price?
Well, we think it's probably going to be stuck in a range for a bit. The market's going to want to see a few quarters of this, not just one. For that reason, our rating is market performance.
But before we go, we wanted to share one more thing. Listening to management talk on the call, a specific trade idea popped into our heads.
So management kept hammering this one point. The market is complacent. Volatility is super low. And what that means is that protection, insurance against a massive, unexpected shock, is dirt cheap right now. They think the market is underpricing this tail risk. So the idea? Do what they're doing. Mirror their thinking. Go buy some of that cheap protection. An easy way to do that is to buy some out-of-the-money put options on a big credit ETF. It's a low-cost bet that this calm won't last forever, and it's a hedge against the kind of macro shock that it seems like nobody's preparing for.
And of course, we have to say, this is not financial advice.